talk about taxes for independent contractors because tax season is upon us, and we got to pay for all that waste, fraud, and abuse that's going on in the federal government. It's got to come from somewhere, so it's coming from you and me. So I paid my taxes. I owed a couple $1,000s, which was disappointing. I was hoping for some money back, but that rarely ever happens. So let's talk about for new owner operators or people who are thinking about becoming owner operators, what can they expect from taxes? Well, it depends on how your business is structured. Uh, Typically, the type of business structure I see most common for new owner operators is a sole proprietor. Now, sometimes they can form an LLC, and that's fine. And these people will pay their taxes quarterly. Um, the thing with being a sole proprietor, you have to talk to your tax professional, but sole proprietors are open to more liability. So, if, for example, you know, you have money in a bank or you have assets and you get sued, then as a sole proprietor, all your assets are exposed to the lawsuit, for example. For God forbid you get in an accident and some four-wheeler wants to sue you. Well, you're a sole proprietor. So guess what? They come after everything you have, every dime you have. So LLC is preferable, which is a limited liability company that provide you a little extra protection. It varies from state to state. Some states provide more protection than the others. So Texas, for example, is excellent. uh, California, New Jersey, Illinois, you may want to check even further because, those are deep blue states, and they may not offer as much protection for small businesses. So taxes are paid quarterly, and typically you'll pay what's called estimated taxes, and it's based on um, your net income for the quarter. So you'll have what's called gross revenue, which is all the money you made for the quarter minus, you know, um, that would be your gross. So let's say, for example, you gross 15,000 per month for 3 quarters. So that's 40, or for first 3 months in that quarter. 15,000 a month for 3 months in that quarter. That's your gross. So your total gross for the quarter is 45,000. Now that's gross revenue. Now net income is what's left after you pay all your expenses, because you got to pay for your fuel, you got to pay for your insurance on your truck, you got to pay for your personal health insurance, you got to pay for truck repairs, you got to pay for your cell phone, everything. You pay for everything. So net income is what's left. So even though you had a gross revenue of 15,000 for the month, your net income may only be 10,000. So for each month, and this is if you're running good, each month you run 10,000, your net income was $10,000 for 3 months, so a total of $30,000 net income for that month. Wow, that's great, because if you extrapolate that over 4 quarters, 30,000 times 4 quarters is 120,000. But it doesn't always work out that way, believe me. But we'll use that as an example. So we got to pay quarterly taxes on that. And quarterly taxes will vary from quarter to quarter. And sometimes they're kind of a surprise. They're like, sometimes they're a little high, sometimes they're a little low. I've had quarterly taxes as high as several $1,000s, and then some quarterly taxes because of breakdowns, stuff like that. I didn't owe anything, but you have to budget and plan for paying your quarterly taxes. And the general rule of thumb that I got from my accountant, and I use with an accounting firm called ATBS, which is very common uh, for very small trucking companies. I think it's American Trucking Business Solutions or something like that, ATBS. I'll put a link in the description when we're done. Um, my tax consultant with them, has given me a rule of thumb that says, look, plan on setting aside 25% of your net income to pay for your taxes. And it breaks down like this. you got to pay your own Social Security and Medicare. That's like 15% of that 25%. And the other 10% is just your federal income tax. So if we are have a net income of $10,000 for the month, you got to plan that there's going to be 25% of that you're going to have to set aside to pay taxes. So you know you're going to have to set aside $2,500 to pay for your taxes. So by the end of the quarter, if you did $10,000 net income for each month in the quarter, you're going to have set aside approximately $7,500 ready to go to pay your taxes. And then when your tax bill comes due and it's several $1,000s, you got the money right there to pay for it. Now, there are stories that I heard over the years of owner operators who went out of business because they couldn't afford to pay their taxes. And typically what happens is it's really common for new owner operators is they spend the money. They spend all their money, and then they don't pay their quarterly taxes. And then at the end of the year, they go to file their annual returns and they owe $20,000 in taxes, and they don't have the money. Guess what? Just put them right out of business. So you have to pay your quarterly taxes, and if you don't, you will pay penalties for not paying, the estimated tax. So, there's no way to get around it. You have to do it, and if you don't do it, well, you pay for it later and you may end up going out of business. So those are quarterly taxes, and then then you have to pay your year-end annual taxes. So if you paid correctly throughout the year, you'll be pretty close to breaking even on your annual taxes. So you still want to save some money to pay for your annual taxes. So let's say, for example, you were saving $2,500 a month to pay for taxes. You did that for 3 months, and you saved $7,500 paid for taxes. Your quarterly tax bill came in, and it was $5,000. You're like, great, I got an extra, $2,500. Don't spend it, save it, because by the end of the year, you probably, will owe it in annual taxes. So, stick to that 25% rule of thumb. Set aside net income, 25% net income for taxes, and that'll keep you out of trouble. Now, let's talk about deductions, because you can do a lot of things with deductions. You can deduct your house. You have dependents you can use for deductions. You can deduct your interest on your truck. You have depreciation value on your truck. These are all different types of deductions. And the federal government keeps coming out with new tax codes, and they're like, oh, we're gonna give a big tax break, for people who buy newer equipment, So they're always giving you incentives to spend money, So it's like, when are you ever going to get out of debt? That because being out of debt is, preferable. And I know guys who paid off their truck, and I've paid off trucks before, and where you don't have a truck payment. But keep in mind, if you don't have a truck payment, then that, oftentimes the truck payment will lower your net income. To lower your net income, the less taxes you pay. And a truck payment will also mean you have a newer piece of equipment, which isn't fully depreciated yet. So you'll get depreciation value as well. And you get to deduct the interest on that truck. So see how this works? The deductions give you an incentive to buy newer equipment, and you're almost penalized for having equipment that's paid off because you don't get all those deductions. So a lot of times people feel that they want to hold on to the truck as long as it benefits them with taxes, but as soon as it's fully depreciated, they're like, well, I need to go buy another truck because I need a deduction. And in many ways, it's kind of similar to a home deduction, because you get to deduct the interest on your house payment. So a lot of times people say buy the biggest house you can afford, because that would be a nice big deduction on your taxes. These things are strategies that different people use, but the common sense wisdom passed through the generations has been become debt free, because you don't know from one year to the next how good that year is going to be. A lot of things can happen in a year. You thought you were going to make some money, and then the economy takes a downturn, and you can't get as much miles. And your whole budget was based on 3,000 miles per week. Maybe you didn't get it. So now you got loans are due, and you can't afford it. So it's a balancing act for sure. And some people are really good at it. Some people are really good with taxes. And all I could say is, talk to your tax consultant and figure out what's the best strategy for you in your small business and how you want to approach taxes. Do you want those deductions? Do you want to have newer equipment and have a higher truck payment, but you'll have more deductions? So you're getting a little bit of break there from the federal government. Say, hey, don't save your money, spend it, and we'll give you tax deduction. I'm not saying that's the right way to go or the wise way to go, but that is a way to go. But let's say, for example, you have your truck is paid off, you don't have any deductions, and you're getting taxed out the wazoo. Sometimes it's very common. Small businesses, small trucking companies will, instead of being a sole proprietor or an LLC sole proprietor, they become an LLC S corp. And an S corp means your business structure is such that you are making yourself as a driver and employee of your company. So you will process payroll just like any company would, and you will pay yourself as an employee. So now instead of getting a 1099 as an independent contractor from the company, that's the tax form. It's 1099. You're an independent contractor. Instead of getting that, you will give yourself a W-2, so that you can file your taxes. And actually, it will lower your taxes. It will give you a big break on your taxes. So if you're just getting hammered with high taxes and you're making good gross revenue, talk to your tax consultant about having your business structured as an S corp and paying yourself as an employee. So there's a lot of strategy going into taxes and deductions, and you got to constantly be aware of what deductions are available to you or potentially available to you. And that may affect your purchasing decisions. About what type of truck you're going to buy, how much that truck's going to cost, how it's going to affect your taxes. What's the interest rate on that truck alone? These things you got to figure all these things out, get answers to, and review that with a tax consultant. Taxes are a very big part of being an owner operator. It's not just the freedom of being on your own, but you also got to take care of your taxes on your own. With the help of a consultant, but you're responsible for those taxes. Other things are, let's say you purchase items for your truck. Are they tax deductible? And yes, that's true. Like say you were at Iowa 80 truck stop and you bought, floor mats, or you bought lights. A lot of guys like to put chicken lights on their trucks. You bought a grill guard. You bought a toolbox. Something like that. It's all deductible on your taxes. The rule of thumb there is, for every $10 you spend, you save about $2 on your taxes. So it's about a 20% savings. So let's say you buy a custom mattress from Iowa 80, and it's $1,000. And you're thinking about your taxes. You're like, well, I can write that off my taxes. That'll save me 20% of $1,000. That'll save you $200 on your taxes. So keep that in mind. Anything you can do to lower your taxes, if you need it, and it's going to lower your taxes, that's a win-win, because you're going to buy it anyways. Now you get a tax write-off. So it's like, say you go to CB shop and you get the biggest, loudest, craziest CB you could find for $1,000 installed professionally. It's all write-off. You save 20% off that. That's a pretty good discount, really. 20% discount, off the asking price. You'll pay the asking price, but then you'll turn in a receipt and you'll realize your savings at the end of the year. So, these are all the deductions. Um, you got to learn about it as much as you can. Take advantage of the ones that make sense to you. Um, plan, your business development, from years to, in advance, what you're going to purchase, what kind of truck you're going to purchase. The thing is, like, when you buy a truck, you're only going to hold on to that truck typically 2 to 3 years. And then you're either going to sell it on your own or you're going to trade it in. And then you're going to get another truck. Well, you got to think about your taxes and your trucks. And if you're gonna buy another truck, sometimes guys like to work their way up the food chain. So they may start out with, a plain Jane type truck that is just, gets them by as a starter truck. But then they work themselves up the food chain where they get newer trucks with less miles, better warranty, and someday they may have a goal of buying a truck brand new. So that all affects your taxes. So these are all things you need to give a lot of thought to. Taxes can be complex. There's no doubt about it, and you don't want to screw it up because it could put you out of business. All right, guys, that's all I got for you. Thanks for watching. We'll see you on the internet.